Investment flash.
Buddy, oil at $87? No way. The Strait of Hormuz is basically a parking lot right now, and the energy trade is absolutely on fire.
Look, it is July 14th, 2026, and the geopolitical risk just hit a boiling point. I am Marie, and we have got Gerald and Tom here for the New York edition of Investment Flash.
Yeah, look, honestly, the Financial Times was flagging these transit risks 3 days ago, but markets only seem to care when the missiles actually start flying. Now everyone is a crude oil expert again.
Gerald, you have to admit that 8% move in the United States Oil Fund, ticker USO, in just one session is massive. That is a 71% gain for the year so far.
Hold on, Tom. That is exactly why we need to be careful here. When a trade is up 70% year to date and then spikes on a headline, you are usually looking at the literal definition of a crowded trade.
100%.
That is the whole story. If we get even a hint of a diplomatic off-ramp, all that geopolitical premium in BP and the Energy Select Sector SPDR fund is going to evaporate in an afternoon.
To be fair, BP is actually saying they expect more oil trading gains because of this volatility. It is not just about the price of the barrel, it is about the chaos in the supply chain that they can monetize.
Right, and BP was up 2% in the last session, which is a solid move for a major. It just feels like everything is being sucked into this one single trade right now.
Wait a second. Let's talk about the casualties. The bond market is getting absolutely shredded because of these inflation fears. Long-duration treasuries through the TLT exchange-traded fund are at a 52-week low.
The thing is, the bond market is finally realizing that the inflation dragon is not dead. It was just resting. We are seeing yields climb because oil at $87 is a tax on everything.
No, but that is exactly my point. This TS Lombard note is saying the Federal Reserve is behind the curve because they are underestimating the AI boom. They think the Fed should be tightening right now to cool things off.
I am going to push back here. TS Lombard is flipping the entire script. They are saying AI isn't disinflationary, it is actually an overheating impulse. That is a wild take when everyone else is waiting for rate cuts.
Look, mate. Analysts revising their theories after the market already broke is basically a free retirement plan at this point. They are just trying to explain why the bond sell-off is happening after the fact.
Ha, fair enough. But Gerald, if they're right and the Fed has to move to a tightening bias because of productivity-led inflation, then my tech bulls are in for a very rough summer.
Not so fast, Tom. Look at the data center builders. The Wall Street Journal says they are offloading billions of dollars in stakes. If the AI trade was truly overheating, why are the guys building the infrastructure cashing out now?
Right. And companies like Digital Realty Trust and Equinix are sitting on huge year-to-date gains. Selling stakes now is just prudent risk management. It suggests we might be near a local top for the real estate investment trust valuations.
For real? I mean, Equinix is up 36% this year. A little profit-taking doesn't mean the story's over. But let's look at something that isn't working. China. Those airlines are a disaster.
Honestly, China Southern and China Eastern lagging Cathay Pacific by 50 percentage points is a massive divergence. It shows that domestic demand in China is still totally in the basement, while international travel recovers.
Yeah, look, it is the same story in the EV space too. NIO and XPeng are getting squeezed on margins because their material suppliers actually have the pricing power. The miners, like BHP Group, are the ones raking it in.
BHP is up 32% year to date. That is the play, isn't it? Own the dirt, not the car.
See, this is what I mean. The structural factors are favoring the commodity producers again. But before we get deeper into the commodities, a quick reminder that everything we discuss on Investment Flash is for informational purposes only and is not investment advice.
All right, let's talk about the other digital commodity. Bitcoin is actually showing some backbone here. It fell with everything else initially, but it is holding steady while the altcoins are getting hammered.
Right. The CoinDesk report says the panic selling might be over for Bitcoin because the sellers' profit margins have basically disappeared. No one is left to sell at these levels.
Hold on. Did you see the sentiment on XRP and Ether? Social media bullishness is at a 5-week high, while the prices are falling. That is a classic contrarian sell signal. The retail crowd is trying to catch a falling knife.
Cooling the bottom on altcoins again. That's about the 6th bottom we've called this cycle, isn't it?
Yeah. I know I said that about semis last quarter too, but seriously, the South Korea situation is a real warning. Their biggest leveraged chip ETF is down 45%.
That Korea move is brutal. The iShares MSCI South Korea ETF dropped 8.5% in just the last session. That is retail leverage being absolutely liquidated.
Right. And at the same time, the Korean government is talking about easing foreign exchange rules in 2026 to internationalize the won. It's a complete mismatch between long-term policy and short-term market carnage.
It feels like a lot of these trades we liked yesterday are getting tested. Gerald, remember when you said we should watch the South Korea ETF yesterday? You were spot on about the volatility, even if the direction was a cliff dive.
Fair enough, though I'd rather be wrong and see everyone's portfolio stay green. The thing is, corporate bonds are not providing a safety net either. Yields are at multi-year highs, but the Wall Street Journal is saying they still aren't enough to compensate for this mess.
I agree. The investment grade and high yield bond ETFs are both sitting near 52-week lows. If you aren't getting paid to take the risk, why would you sit in LQD or HYG right now?
Spot on.
That's why the Our View section today is so focused on this barbell approach. You have to stay long the crude oil trade because of the physical reality in the Strait, but you've got to be short the long-duration bonds because inflation is the clear and present danger.
But we have to mention the risk of a reversal. If there is a ceasefire or some diplomatic breakthrough, oil could drop $10 in a heartbeat. I'm keeping my stops incredibly tight on the United States Oil Fund.
Honestly, the most interesting part of the day is the media merger drama. 12 blue states trying to block the Paramount and Warner Brothers Discovery merger on antitrust grounds. That is a massive headache for those synergies.
No, but that's exactly my point. The regulatory environment is becoming a minefield for these big deals. Warner Brothers was up nearly 2% in the last session, but it's still down 5% for the year. The market is pricing in a lot of failure risk.
It's a tough environment for anything that isn't oil or AI infrastructure. Even gold is struggling. Gold was down 3% last session. Why isn't it catching a bid with all this war talk?
Because people are selling what they can to cover losses elsewhere. It is a liquidity event. But Bloomberg suggests gold could be a catch-up trade if this crisis deepens. The gold ETF is down 8% year to date, so it's a contrarian entry for sure.
I'm going to watch copper too. The CPER exchange-traded fund is up 1.5% this week. If Hormuz stays blocked, it's not just oil. It's the entire industrial supply chain that gets choked.
Wait a second. We're talking about a global recession if that happens. This isn't just a trade. It's a structural shock.
Look, I sounded the same about Cisco in 2000, and look how that turned out. Markets have a way of overpricing the apocalypse and then forgetting it happened 2 weeks later.
Oh, that's brutal. But you're right. We have to keep our heads. Today is about reacting to the oil spike, but tomorrow is about seeing if it sticks.
Totally. If you are following along and want to see the charts behind these moves, hit follow on Spotify or check out investmentflash.com for the full digest.
Great call. We are wrapping up the New York edition for today. We'll be keeping a very close eye on those Hormuz headlines throughout the afternoon.
Yeah, and I'll be looking to see if the European markets have any more sense than this one when they open. Probably not, but one can hope.
We're back tomorrow for the next one. We will see you for tomorrow's London edition at 7:30 a.m. London time.
See you then. Stay sharp out there.